So Kenneth Leon's with us, Global Director, Industry and Equity Research at CFRA, and David Chiaverini, Managing Director, Equity Research at Wedbush. Thank you both for being here. Obviously, they had a few things that are overhangs, the regional banks that they had some fees and things there. What did you think, Ken? What was your takeaway? I mean, what was a winner? What was a loser? If someone said, how did the banks do to you today? And you always do a spectacular job of sort of summarizing, but maybe with some detail so that people can understand a little better, Ken.
Well, first of all, bank stocks today are kind of going sideways, mostly because they had outsized gains in the fourth quarter. What we learned with the results today is that for 2024, the U.S. economy is likely to be going to a soft landing, not a recession. Without a recession, the worries about credit loan losses accelerating seems quite low. The opportunity we see is really still for some moderate loan growth. Of course, there's a major change in terms of the direction of rates. That impacts banks for net interest income. But if you still have loan growth, that will contribute to net interest income. Uh, the investment banking area widely noted that we hit the trough the middle of last year, a slow start this year for M&A, equity and debt underwriting, but we expect it to improve as we go through the year because there's an enormous backlog, particularly from private equity firms looking to monetize their investments. Lastly, I would say that the banks are really focusing on expense control. In some ways, this is giving them a good floor to whatever happens in the economy.
And so at this time now, I mean, when you think about the change in direction of rates, and you have Bill Ackman out today saying that he sees the Fed's moving even more rapidly on interest rate cuts and saying that they have to move early in order to get more than three cuts in for this year, 2024. David, I'm curious, what did you think about the entire picture? What stood out to you as maybe some wins and losses?
Sure. So since I cover the mid-cap banks and the regional banks, I was looking for read-throughs from the money center banks to those companies. And what really jumped out to me was all this focus on, commercial real estate. I wanted to see to what extent it is coming through the financials and non-performing loans. And unfortunately, looking at Wells Fargo first, their commercial real estate non-performing loans increased 8% sequentially to 4.2 billion. And then Bank of America, it was even more troubling looking at, again, focusing in on commercial real estate non-performing loans, increased 43% in the fourth quarter to 1.9 billion from third quarter's 1.3 billion. So that gives us a little bit of concern on the credit quality front. I am hopeful that we do have a soft landing to kind of soften the blow, but based on this credit migration, that could be a key concern. And then the other thing that is a little bit worrisome coming out of the prints, which is why I think mid-cap banks and regional banks are down here, is the discussion around net interest income and the trajectory through 2024. JPMorgan is guiding to sequential quarter declines in net interest income through the year. And Wells Fargo, they gave guidance of being down 7 to 9%, which was below the consensus view, which is why I think that stock is under pressure here. So deposit costs are high and look like they could be sticky. And then as it relates to stickiness, JP Morgan mentioned about inflation could be a little bit more sticky, and that quantitative tightening could also put some pressure on yield. So I don't think we're necessarily out of the woods yet on the upward pressures on at least the medium to long-term bond yields. And it very well could result in the Fed, to your point about Bill Ackman, if that does put additional pressure on the economy from higher rates on the medium to long-term bonds, it could cause the Fed to, move a little bit sooner. So we'll have to see how that plays out. But our takeaway is that this is a little bit of a cautious stance as it relates to mid-cap banks and regional banks.
Yeah, and you make some great points on the commercial real estate non-performing loans. I mean, I think the one with Bank of America in particular was certainly a surprise. Their net interest income is certainly in focus for 2024. And when you look, Ken Leon, at these names, I mean, when JPMorgan talks about sequential quarterly declines on this, are you surprised to hear that? And which names do you like as buy ratings right now? In the meantime, Citi announcing 20,000 jobs cuts in the medium term. I'm not sure people expected to hear that today, but we know that everybody's looking for efficiency. Ken, what are your favorite names in the group? Do you have buys?
Sure. So we have a buy on JPMorgan Chase and also Morgan Stanley. We're going with quality, and we do believe that when you look at the other names, they're story driven, such as Citigroup as a multi-year transformation. There's going to be bumps in the road as we go through 24 for Citi. The expectations from analysts is high for Citi. Stock has done well. Wells Fargo, we have a hold. Bank of America, also a hold. I would point again that commercial real estate, in order of magnitude, is really not that significant for the large global banks. They have also reserved mostly for commercial real estate.
Right. David, what's your favorite name? I know you cover mid and regional type banks. Do you have a favorite name?
Sure, I'd point to First Horizon,
Quickly.
FHN. I'm expecting their net interest margin to improve because they are lowering the promotional deposit costs that they put out right when the TD merger was terminated. They did some promotional CDs. They're repricing those lower, so that should help. And then on the expense front, their expenses I'm expecting to be incrementally lower because the $100 million of tech spend that they're expecting, we're expecting that to be kind of pushed out a little bit. And the other one, I'll say Fifth Third. They have the lower CRE exposure of the regional, so I'm comfortable with that as well.
I'm going to have to leave it right there. David Chiaverini and Ken Leon, great to see you both. A nice cut down of those banks, and we'll take a look at more next week.